Hey guys, it's Jack. Today we're going to be going through what investment trusts are, how you can make money with them, as they have certain features that aren't really available with regular stock investing. We'll be also going through how to pick funds that are right for you and how you can go ahead and get started today. It's going to be a full guide, a whole jam-packed video on how to make money with investment trusts like you've never seen before.
Perhaps like we've never seen before.
A quick disclaimer before we begin: I'm not a financial advisor and none of what will be discussed today should be taken as financial advice. An investment trust is a type of company listed on the stock market that specializes in investing in other companies. When you invest in an investment trust, your money is essentially being pulled together with other investors to buy a wide variety of assets like shares in public and private companies, bonds, property, and even infrastructure. The benefit for you is that investment trusts are designed to give you access to investments that you otherwise would not be able to acquire or get a piece of, simply because of the amount you're investing with. An example of such trust is BBGI. With this investment trust, you get to indirectly own a piece of police stations across the UK, prisons, and even schools. It is very difficult as an individual investor, even if you had a couple £1,000,000 to own a piece of such a diversified portfolio directly. You would have to literally acquire the land, do some construction, and try to set up some contract with the council. Doing that will be quite difficult even with a couple £1,000,000, whereas you can just acquire BBGI shares for as little as £1.70 each. And investment trusts are not new types of investments. They're actually one of the oldest investment methods in the UK. The first one launched back in 1868, the same year helium was first discovered, and the same year of the last public execution that happened in Britain. Yeah, I went a bit morbid at the end, but just to give you guys some context on how old these trusts may be, and therefore how much data we have to figure out whether these investments will indeed print the cheddar or not. First thing we need to know before diving into the money and figuring out how to actually choose an investment trust is to clear up the confusion a lot of investors may have, and that is indeed confusing investment trusts with unit trusts or open-ended investment companies. Now, why people may get confused is that most of the time these are all dealing with a similar type of investment strategy, which is investing in assets with pooled capital from investors. But here are the key differences so you don't end up investing in the wrong type of thing, which will definitely impact your overall return as well as increase your risk. Investment trusts are closed-ended investments. When they are set up initially, they issue a fixed number of shares in the market. For example, a new investment trust launches and they issue a sale of 10 shares of £100 each. That's £1,000 the management team have to their disposal to go ahead and invest in assets. The management team behind the investment trust do not have to buy and sell assets to allow the public to redeem their shares. I'll get onto this in a second. Once the shares are in the market, the public will ultimately decide the price of the shares. Just like any other stock, the public would exchange the stocks and money between themselves. Unit trusts, however, are a different kind of investment. They are kind of the flip side to this. Unlike investment trusts, which are closed-ended, unit trusts are open-ended investments, which means the relationship is between the investor, so me and you, and the fund manager. When we want to buy shares, we're buying it from the fund manager, and when we want to sell shares, we're selling it to the fund manager. When you're selling the shares, the investment manager will actually pay you based on the latest price of the assets the fund holds. There are three advantages on why investment trusts are better than unit trusts, in my opinion. One of them is that in a market downturn, a huge amount of people may want to sell their investments. In investment trusts, other people getting out and selling low won't really affect you much. Yes, your share price may collapse, but that's like any other stock. But with a unit trust, it will absolutely affect you. Because the fund manager is in charge of giving investors money for their units, their shares, the fund manager will have to desperately sell their assets to raise money to do so. Normally, they keep a small amount of cash on the side to cover unexpected demand for investors liquidating their units, but a huge amount of investors liquidating at one time will mean they are in trouble. As a result, fund managers might have to sell their properties or other assets at a loss to allow investors to withdraw. And as you own a part of the fund, those losses due to other investors liquidating are going to affect you. This is why investment trusts are more superior in my opinion, because you don't have to worry about other people and their silly mistakes. If people want to sell their shares in an investment trust, it will be to other investors in the public market. As well as this, investment trusts don't even have to keep cash to cover investors liquidating. This means that your returns won't be impacted by inflation affecting those cash deposits held up by those unit trusts. There is also a third benefit that lies with an investment trust over unit trust, and that is the ability to buy stocks or assets at a discount to what they're worth. You might be thinking, wait, how do I get Tesla at a discount? Is there some sort of membership club I'm missing out on? Well, you'll be pleased to know there isn't a membership club, and you can utilize these strategies and concepts I'm going to be explaining next. With investment trusts, there are concepts known as discounts and premiums. As I said earlier, investment trusts are publicly traded, so their share price is determined by literally what other people are wanting to pay for it. The share price will go up and down due to supply and demand. Now, having said this, on the other hand, the value of the underlying assets the investment trust holds is published every day. This is the value of all the stocks, the property, and all the assets put together, and this is also known as the net asset value. Now, as you already might have figured out, the share price or the market cap of the investment trust will not always match the NAV. We'll get to look at some examples of this in a second, but before we do, the key to remember is that the difference between the share price and the net asset value is presented and calculated as a percentage of NAV. If the share price is below the NAV, then the company is trading at a discount. If it is higher than the NAV, then the company is trading at a premium, in which case you are paying more for the asset than what the asset is worth at the time. Now, before we look at what are the real reasons on why discounts and premiums will occur in the first place, let's check out some real life examples. One example is the Standard Life UK Smaller Companies Trust. This is literally a trust that aims to achieve long-term capital growth by investing in small cap UK companies. The current discount is around 7%. The trust price is 7% cheaper than you going out and buying the underlying portfolio yourself. On the flip side, the London Trust PLC is trading at a 2% premium. Now, why would this occur in the first place? Should I just go out and buy all the trusts that trade at a discount? Well, not exactly. While it might be a good reason to buy trust if it is trading at a discount, it can't be used as a standalone reason. A discount can arise because of the fact there's more sellers than buyers in the market. There could be years of poor returns in a fund that may cause an imbalance, or the industry that the specific fund is investing in may be in decline. However, I do personally look out for trusts that have somewhat of a discount, as it means a good buying opportunity as things may turn around. On the flip side to discounts, premiums may develop whereby the fund is more expensive than the underlying portfolio. This is likely due to one of two reasons. One being consistent outperformance. This is when the fund has outperformed the market or the benchmark for a number of years, and investors feel like it's actually worth getting into the fund as the benefits may outweigh any premium paid for it. The second reason is that the asset class or industry is in favor. Let's just say the fund is specializing in electric vehicles. There is a huge amount of money pouring into this relatively new industry, so investors are willing to pay a premium to get in, as they more often than not have a fear of missing out. Don't fall into a position where you're falling into this trap as well. There'll be plenty of opportunities. Don't let your emotions dictate your investing. Having said this, most of the top investment trusts nowadays have rules to buy and sell shares, ultimately to keep the discount or premium as narrow as possible, although you will see imbalances occurring on a daily basis. Before we discuss the fees and how to find an investment trust suitable for you and what best platforms you should use to actually go ahead and buy them, let's take a look at a very underrated factor, which is indeed the role of the board. Similar to other companies, investment trusts have a board of directors, which has the authority to appoint a portfolio manager and ultimately decide the investment policy. If the portfolio manager is performing poorly, a good board can decide to replace the portfolio manager quickly. A bad board may delay it, which may cause harm to the fund's underlying portfolio and ultimately cause harm to the funds for the returns you receive. The gearing policy is also determined by the board. By gearing, we're not talking about top gear here. We're talking about leverage, or how much money the portfolio manager is able to borrow to increase the investment in the assets they may wish to hold. The board also sets the dividend policy. Now, this is very important because if you're investing for income, you don't want to invest in a fund which doesn't prioritize this, because that is your specific objective. Now, board members are meant to be independent and should be easily able to replace the asset manager if need be. A good board would have industry experience. Let's let's just say you're investing in investment trust that specializes in pharmaceutical companies to invest in. As an investor, I want my board to at least have a good accounting experience, but a good factor would be if my board members had experience in managing or running pharmaceutical companies. The board of directors have unrelated experience or have a poor reputation of management. I would have to factor that into my risk when investing, i.e. my calculation or my assessment of the opportunity would have to show a greater expected return for me to invest to make up for that risk factor. Okay, so what are the fees associated with investment trust? There are actually 3 types of fees you're going to have to pay. One is the upfront fee, which you're going to be paying when buying shares. Your broker will charge a dealing fee. Either it's going to be a fixed fee or a percentage of the investment. The second fee you're going to have to pay is the stamp duty, which is a tax in the UK set at 0.5%. It's only on UK stocks. You don't need to worry about filing this, as this is very common for brokers to just embed this into the cost when you're buying. A third fee is arguably one of the most important fees, is the ongoing charge. This is a fee taken as a percentage of the value of investments and is directly going into the hands of the management team behind the trust. What you must remember with this fee is that it's the value of your investments, not the money you deposit. As your investment rises, so will this fee relative to your investments. So as this fee will impact your actual returns the most, it's a good idea to pick funds with as lower fees as possible. You could be paying anything between 0.01% to 1 or 2% with certain trusts. However, most of the good trusts will lie in the 0.20% to 0.40% range. Now, fees are an important factor, but other factors include the identity of the fund provider. Who is actually offering the fund? What are their credentials? I would strongly avoid funds whereby the fund provider is relatively new or is a relatively new company, or the management team has no track record. Another factor is liquidity. This is a term used to describe how easy would it be to sell your funds at any given time. Remember, you need other investors to buy on the other side. Now, smaller funds won't have much liquidity. This is because there's not enough people selling and buying specific stocks. I would strongly avoid funds that have low market caps, especially in the hundreds of millions of pounds or lower. Check the trading volumes before you buy funds to actually see how liquid they really are. Remember, there is no point being the richest person on paper when you can't withdraw, and this rule is with any given stock for that matter. Now, these were some of the things. I'm going to do a full video on the entire factors list, but let's just get down to what broker you should use and what funds I like. So the broker I use is Freetrade. If you sign up using my link in the description, you can actually grab yourself a free share valued up to £200. Just to be transparent with you guys, as I like to do, I will also get a free share in return of you signing up. The second broker you can use is Trading 212. It really doesn't matter with any of these brokers because they're both commission free. You don't have to be paying the upfront dealing costs that is prevalent with other brokers. But that's the brokers out the way. What are my favorite trusts? One of my favorite trusts is the Scottish Mortgage Investment Trust. This has performed quite well for me over the last 5 years. The ongoing charge is quite low at 0.34%, and it trades at a relatively small discount in the current market. Now, I'm going to leave the full analysis of this trust in an upcoming video, which will be about my opinion on whether it is the right time to buy or sell this trust. Please make sure to subscribe so you don't end up missing up on that video. Also, guys, let me know your thoughts, questions about investment trust in the comment section. While you're there, if it's not pushing it too much, please leave a like as well. Thank you so much for watching, and I'll see you in the next video. Bye for now.